Hello, everyone, and welcome back to another awesome episode of the BIF Bites podcast. I'm your host, Jerry Me, joined by always by my faithful co-host, Mr. Brendan Flaherty. How's it going, Brendan?
I'm great, thanks. How you doing?
Awesome. And unfortunately, our friend Mike Long is unable to make it on this episode, but that's okay. We have a great stand-in for you guys. First time on the podcast and newest members of the Boston Institute of Finance team. Joining us for his first episode is Adam Scherer. How's it going, Adam?
Hey, Jerry. Hey, Brendan. Great to be a part of this. Long-time listener. Glad to be part of the conversation today.
It's not saying much
Can't
when
be
it's
that
part
long.
of your part of your job description. You have to listen to it.
Yeah.
So Adam's the newest member of the team. Adam, can you kind of let our listeners know a little bit about like what you do here, kind of what your role is, and how you're involved in the CFP world?
Yeah, absolutely. So my title is Director of Curriculum, but on the CFP side of the business, side of the world, and looking to make our CFP content the best out there for all the students that are working through their education requirements and getting ready to sit for the exam. So there's quite a bit of work that's inside the content just to make sure that it's understandable and clear, thinking about how best to present different concepts for our students, also supporting them as questions come up, and writing new questions that are going to test their knowledge, give them space for application of concepts, and just basically being for them the whole way, whether they need a little advice on a question or bigger advice about, now what? I got my CFP marks, now what do I do? Or I'm thinking about getting my CFP marks. How do I go about that? So like many of us, a lot of different things that we do here, but just really, really happy to be with the team and helping our students out.
Awesome. And bringing in tow with you today, you also invited your friend who is our guest of honor on today's episode. You want to introduce your tag along, Adam?
Yeah, this is Mr. Jon Robinson of Blueprint Investment Partners. Jon, are you the founder of Blueprint?
Co-founder.
We got connected through one of my old friends from my first job in finance, your sales manager, Mike Carlone, and had a fun discussion last week where my daughters literally gave me the hook at the end of the talk. They put a hanger over my head and pulled me off screen. So
it was one for the books. It was great.
Yeah.
Awesome. Well, yeah.
End scene.
Great to have you on the cast this week, Jon. Really interested to kind of pick your brain about the industry side of the finance world. As CFPs, we tend to really focus on financial advisors and the individual client, and I don't think that enough attention is given to the industry side. So it's going to be great to get your perspective, as a founder of a mutual fund, and kind of pull the curtain back a little bit and see what's going on behind the scenes.
Yeah, thank you guys for having me. It's good to be with you.
Definitely.
And now I understand that it says on your website that you're the co-founder, but you said you wanted to go on record here that the whole thing was your idea.
Yeah, he doesn't know I'm doing the podcast. So for these purposes, I'm the founder. Absolutely.
Yeah,
Brandon Langley is not a co-founder.
Yeah.
Excellent. Yeah. All the credit.
And he's frankly, he's the brains behind the whole deal anyway. So he'll ultimately find out about the podcast, and then I'll be then we'll have a great discussion.
Well, yeah, definitely want to talk more about the Blueprint Mutual Fund. But first, as is tradition, we're going to warm up with our question of the episode. Are you ready, gentlemen?
Yeah.
You bet.
Awesome. So, your young neighbor, Susie, recently received $500 for her birthday. She is an aggressive investor and wants to get every penny invested right away. She also wants to invest the $100 she makes each month from her paper route. She is very interested in investments and knows that she should invest in a well-diversified portfolio. However, she also knows that she is still learning and could use some guidance from experts with experience. What type of investment would you recommend as the best fit for Susie? Is it A, blue chip stocks, B, AAA rated bonds, C, low cost ETF, or D, diversified mutual fund? Now, this question seems like a layup that we would get on the CFP exam, but there can be actually a little twist at the end that I want to talk about. But before we get into that, Brendan, what do you think about A, blue chip stocks for Susie? How do you feel about that?
Yeah, I think given if she had the appropriate risk tolerance for it and then the time horizon lined up, I think blue chip stocks would be a perfectly acceptable route for her to take. The issue is the amount of money that she has to invest. So if we were going to look at some of the blue chip stocks today, now that we've got splits that just don't happen anymore, she doesn't have enough for one share. And so I think it would be difficult to give her a very well-diversified portfolio. So I think we would have to move on to something else.
Adam, what do you think about AAA rated bonds for Susie?
It'd be a nice part of a well-diversified portfolio. But based on the facts about what Susie wants, I don't think it's the best choice, given the goals and given the circumstances. Can certainly provide some diversification if she had more of a well-rounded, well-diversified portfolio to begin with. But given her goals, given her aggressive risk tolerance, I would strike that one out. In fact, that'd be the first one to go, in my opinion.
I agree with that.
So A and B are out. Now, leaving the toughest for Jon. Jon, in your completely unbiased position as a founder of a mutual fund, should Susie go for the low-cost ETF or the diversified mutual fund? What do you think?
I'm not, if you had to pick one person to take a test for you, should be the last person on your list. However, in this case, I'm going to go with diversified mutual fund, not because we operate one, but because of the fact pattern here. First, Susie wants to get all of the money invested, right? That's a key point here. Mm-hmm. She wants to get every penny invested right away. And she wants it well diversified, right? And the mutual fund allows you to invest every penny. And the diversified mutual fund allows you to access a broad mix of asset classes. So yeah, I'm going D, diversified mutual fund.
Yeah, that's the right answer. Yeah, and you nailed it there. The key points to look for is she wants to invest every last penny. While the firms have started introducing fractional shares, and that's kind of a conversation for another day. That's a new product on the market, is being able to buy fractional shares, so you can buy in any dollar amount. But traditionally in the market, mutual funds have really been the only investment option that you can invest down to the very penny. Everything else for stocks, bonds, and ETFs, you need to buy in share quantities and buy it based on whatever the going rate of that individual share is. So you're almost always left with a little remainder cash left over in the account. And Jon doesn't want to toot his own horn too much here, but I'll do it for him. The other key point to look at is, she's looking for guidance from experts with experience. A big differentiator between ETFs and mutual funds is, mutual funds have a team of experts behind them. ETFs do have teams, but really ETFs are kind of I don't want to say set it and forget it, but it's more based on an algorithm, whereas mutual funds, I feel, traditionally have a more hands-on experience. Am I off base with that?
No, I don't think so. I mean, even for a shop like ours that uses systems to make decisions, you still need a designer of those systems. And, the best systems designers are those with that have been educated, in statistics, but also have market knowledge and experience to draw from when designing those systems. And probably lastly, the most important thing is implementing those systems consistently over and over, which is the most important part, is that consistency factor. And that really, doing that in high efficacy way comes with experience. Experience, helps in that regard. So yes, I think that's right.
Awesome. And I think that's a great segue to kind of get into, Blueprint, as a fund and as an idea. Can you kind of give us the 5-minute elevator pitch? It's a really long elevator ride. So what's the Blueprint kind of elevator pitch for us?
That's okay. I'm from the South, so I like to tell stories. So I like 5-minute elevator rides. So Blueprint is an asset manager that is designed to serve financial advisors, particularly financial planners. We focus a lot on behavior. We focus a lot on being behaviorally friendly. So both our behavior in terms of being systematic and being disciplined, as I mentioned before, and that's just going to be something I repeat over and over because that's just one of our core principles. But ensuring that our behavior is appropriate and that we're executing the strategies in order to increase the probability that the client achieves their goals.
Yeah, that's awesome. And especially, like you mentioned, the behavioral finance piece of it, that's becoming a bigger and bigger piece with the CFP exam. It's really being a focus of not just CFP professionals, but financial advisors in general, just really understanding the psychological nature of the market and their clients. So it is really interesting to see that you guys put that at the forefront. But we'll talk about that in a bit. But also I wanted to mention one thing I thought was very interesting when I first looked at Blueprint's website was kind of your focus on transparency, which is something that is kind of unusual for the mutual fund world. Most mutual funds won't even reveal what their 11th largest holding is. They reveal 10 and that's it. That's all you get. Anything beyond that's the, proprietary, closely guarded secrets. Yeah.
Look, we, it wasn't without a dent to our ego that we made that decision to be completely and fully transparent, right? Where our ego came into play is, well, okay, if we let everybody know exactly what our rules are our rules special and were they ever that special, right? Were they the secret sauce? And what we realized when we put some heat to that idea is that they are, the rules are very important and they're well researched and they're statistically sound and they're robust. However, the secret sauce is in daily discipline that it takes to run the strategy day in and day out and follow it consistently. The analogy I always say is it's no different from the diet and exercise. Diet and exercise, in order to be healthy and be fit, the equation is very, very simple, right? You eat a certain amount of calories and you do a certain amount of exercise equals I'll be generally healthy and I'll be generally fit. And look, I'm the last person that should be having that conversation with you, but I'm just drawing from the analogy that we feel it's an analog to successful investing. It doesn't have to be, and in some cases should not be complicated. It should be simple, but not simplistic. And it should be done but it should be implemented with a very rigorous discipline process. And for us, that's the key. So if that's the key, then we'll tell you what the rules are, because look, the truth is that as soon as the rules give you something that you don't like or hit one of your biases, you're going to change the rules anyway or stop following them. So,
right.
So that for us is sort of a moat, if you will.
Yeah. So sticking with the diet and exercise analogy, it's almost like you guys are the fitness coach. Everyone knows the equation of diet and exercise equals long-term health. The trouble and where the behavioral finance comes into play is actually sticking to those rules when the situation gets a little uneasy, the market starts getting choppy, and people might not want to stick to that guideline. You guys are there to kind of help people stay on track.
I tell you, Jerry, I think that's right on the money. I haven't thought about it in those terms. The thing I would say, just to add to that, because that's right on point, is if you had a trainer that could actually exercise for you.
Yeah, sign me up.
And when you're an investor that can as an investor for others, you can do the hard things and they get the benefit in that case, right? And so, it's unique in a sense, but to your point, it's very similar. Yes.
Hey, John, I have a question. So I want to go way back in time. I'm interested in your skill set and your alleged co-founder's skill set and background. How did you end up arriving at that point where you said, let's give this a go. Let's do this. This is our path. What was your background like? What about his?
Yeah. So it's a good question. So going way back, I come from a family that runs small businesses, and it's blue collar to small business entrepreneur, right? So growing up, I just got to see, I thought that was normal, right? So I always had that bug to do something on my own. I had various businesses just growing up that, were fun and obviously didn't amount to anything, so you pair that with this interest in finance and trading and Wall Street and, some of the more fanciful ideas that you have watching movies, fantasy, especially compared to what it actually is when you get there. And
was Gordon Gekko a hero? Is that what you're trying to say?
Yeah. It's funny. I gravitated more towards like Billy Ray Valentine than I did Gordon Gekko.
There you go.
That movie's based on a true story. Trading Places. That's based on a true story.
Yeah. Unbelievable.
Yeah.
So when I knew I wanted to get into, I interned at Merrill Lynch in college. And I interned for investment, but just anything I could do to get experience there. And so I knew, okay, if I want to do this, I want to try to do it at the highest level. The highest level is Wall Street. But how does a guy from rural North Carolina, Greensboro, North Carolina, with a Rolodex that doesn't even have a card? It's just the plastic piece. There's no cards in my Rolodex. In 2002, how do I do that? And so what I did was I basically pulled down, this is before LinkedIn, so I pulled down all of the New York Stock Exchange member firms. And then I tried to link that back to an alumni database at UNC Greensboro, which is where Brandon and I both went. That's how we met. And I found one guy that nobody had ever heard of who used to be the chief risk officer for Bear Stearns and was running their specialist firm, which is to say their New York Stock Exchange market maker, Bear Wagner Specialist. He was running that with a trader who's, also in one of those really fun books with, Ivan Boesky. His name was John Mulhern. So I said, okay, he does. If I'm him, I don't take calls, right?
Right.
And I especially don't take calls from people I don't know. And I especially don't take calls from, 20-year-olds from North Carolina trying to get a job. So I wrote him a letter and I sent a FedEx because I said, few people turn down FedExes. And he got it and he called me and they had me up for an interview and they hired me. So that's where I broke in, about a week and a half after I graduated. I was on the floor of the New York Stock Exchange and was trading it for a specialist firm.
That's an awesome story. That's really getting your name out there, making an impression on people. Like you said, sending them a FedEx, not just calling them up. That definitely takes some gumption.
It was something. It was as you might imagine, I'd already been up there a couple of times during spring break and doing stuff I didn't have any money. So, I would just get there however I could. And I would stand outside, like a schmo, handing out resumes to traders as they would walk off the floor. Then when I'm a trader walking off the floor and seeing some guy handing out resumes, my immediate thought is, leave me alone. And I'm like, wait a minute, no, you were just that guy. Like, what are you talking about? So,
good.
At a brief moment of, after my brief moment of major hypocrisy, I would at least strike up conversation. But so after trading, I moved, my idea was, okay, if I want to be a money manager, then I need the analytical side to it as well. So I became an equity research analyst for Prudential covering software stocks, and that was completely different. I mean, one is a sprint and the other is just an absolute marathon. And so, I was modestly, and I'm putting modestly below moderately, okay, successful at those jobs, but I could just never shake this feeling that I wanted to do something for myself or break out on my own. And Brandon and I had been trading. He was here getting his master's degree in economics back in North Carolina still, and he was starting to work in risk management for Wachovia at the time. So we were trading an account that we called a joint account, but it was all his money. And along the way, we just started to say, okay, what would it look like? What would we do? And then I got turned on to some research and some books written by Michael Covell and some others on this philosophy of being systematic and trend following. And so we started running simulations because we're nerds, and that's what nerds do on weekends. And, really diving into this body of work and decided, okay, this is the entry point from an investment perspective, which look, going from being an equity research analyst to a systematic price-based trend follower is like, changing religions.
Right.
I mean, it's different. All my fundamental friends stopped talking to me for a while. It was just like I was
betrayal.
I was a total heretic, which is understood. So we started our first company was we started a managed futures fund back in 2007.
What did you focus in?
Great timing.
Anything specific or just general?
Yeah. So okay. So first of all, if you know anything about managed futures, you know that may have been the only good time to have started a managed futures fund.
Yeah.
Right.
2007. But what we focused on was we were really we were generalists. So we traded as diversified a portfolio as we could, because statistically you need at bats. You know what your average is roughly. You need at bats, and so markets give more and more at bats. And we were agnostic to market direction, and we started with $60,000 in a commodity pool, which is the legal name for a limited partnership that trades futures. Again, if you know anything about futures, if you have $60,000, you have a choice.
You can lose that in a day.
Yes. So you either don't trade as many markets,
Right.
You're very, very, very highly leveraged. And so we did that version. We were highly leveraged. And 2007 was a great year because that's the first time oil went above 100, and I don't care where you buy oil on the way to 100. If you do it with a lot of leverage, you're probably doing okay. And then 2008 was even better because we were agnostic to direction and we were following trends. So, their commodity currencies were way down, stocks were way down, bonds were way up.
Did any of your leverage dry up? Did you have trouble sourcing capital?
No, good question. Just because of the nature of, we would have. So if we were using more of a collateralized model, trading like cash stocks on margin,
right,
there's no question we would have been blown out of positions.
Yeah.
But just the nature of futures, we were able to get all the leverage we needed just because of the inherent nature of the futures contract, right? So for example, when you buy an oil contract, your initial margin is, $1,000. And if oil's at 60 a barrel, the contract size is 1,000 barrels. Right. So it costs $1,000 to control that contract. So, Jerry, to your point, it doesn't take but a couple of ticks against you, to wipe you out. So cutting losses, we learned how to cut losses quick in that environment. So, we had, at the time, there weren't a lot of great 40 Act fund options in that space. So independent advisors would set up their own partnership and have us operate it. And they would offer it to accredited investors. And they came to us in 2009 and said, hey, look, we love your philosophy. We love your strategy. We love that you're systematic. And however, we can't prudently as a fiduciary put any more than 5% of our accredited investor assets with you. But if you could domesticate what you're doing away from these really esoteric things called futures and all this leverage, keep these core principles, but now migrate those over to ETFs and mutual funds, we would consider letting you run our whole book. And that was a Godfather offer for us. So we started down that path, and in 2011 launched strategies that focused on ETFs on a white label basis, and spun those into Blueprint in 13, made that white label relationship a sub-advisory client, and then started offering Blueprint branded strategies going forward.
So one last question before we kind of move on from the career path, because we do have some other good topics I want to make sure we have time to get to. But for our listeners who are, seniors in college right now, or career changing, if I'm a veterinarian assistant right now who wants to break into the finance industry, what is some advice that you would give our listeners who are in that position, and they want to be a mutual fund analyst, or they want to kind of shadow your career path and get involved in the industry side of the finance world?
Maybe the best advice I would give. So if I was giving advice to my kids, find somebody that you consider at the top of their game in the field, and pursue them. Pursue them through sending them a FedEx, pursue them, take them with in this day and age, you can't show up in somebody's door necessarily, but hopefully that will pass soon. Send them an email, connect with them on LinkedIn, do whatever it takes to try to find someone to have a conversation with. First, next best step, have a conversation with somebody who's elite in the field, right? Because I just think, number one, that will give them confidence, first of all, and it will get them down the path of, okay, in most cases, there's a million different avenues to go down in terms of learning about a topic. And some of the most difficult, at least in our career, when we were looking at different areas of research and futures, there's a million studies out there. How do I shrink that list? What's my criteria for shrinking that list down to 10? Because I can only consume so much, and I can't wait 10 years to start this thing, right? So what are the key elements? What are the crucial elements that I need to know, or places that I need to look, stones I need to look under, in order to get started? And then I think it is about overcoming that fear of just getting started and making mistakes. And I'm speaking from experience. That's something that I've definitely dealt with and struggled with, just because we started, the indication in my personality that we started a company in 2007 with $60,000 under management is less an indication about that I'm not fearful, and it's maybe more an indication that I'm just crazy.
Yeah. I mean, you started a company in 2007, on the brink of the financial crisis. It really is kind of the pull yourself up by your bootstrap story. Other people say, oh yeah, we started this company. Meanwhile, they have, $10 million injection of capital. But you guys really did start it with just, your buddy's bank account, basically.
Yeah, pretty much. Exactly. And so, there's a saying that courage, having courage does not mean the absence of fear. Right. So, I would just say have courage and get started, because once you get started, the most important thing that is going to happen, which is you start to feel it. And then right? Because you can have all the head knowledge in the world, but until you feel it in your gut, you won't really know what it's going to take. And that's that feedback loop, that starts the feedback loop. So I would just say, find an expert, or find someone you deem in the realm of experts, to centralize your focus on what your entry point might be, and then start walking and start taking steps.
So I think it's valuable. Obviously the behavioral finance piece is still something that's relatively recent in terms of the history of investing. And it wasn't that long ago that people looked at you funny if you said that you were concerned about behavioral biases. So how does trend following eliminate the behavioral biases that a lot of investors and advisors fall into when they're managing their money or someone else's?
Yeah. So the first thing I would say is, there's really in that instance, there's three sets of emotions that you have to account for, right? There's the investor, there's the advisor, and there's the client. So trend following lends itself to being codified and put in a systematic framework. So that helps manage the emotion of the investor because you know exactly what it is that you're going to do in response to X, Y, and Z. And you can go back and, assuming that you've designed a strategy with few parameters, right, and not overly biased it to past data, you can take a lot from simulating that over past data in different environments, in different geographical regions, in different contexts to see how it would have performed and walk through that, not just because you're trying to look for the optimal solution, but what you're really trying to do is optimize a strategy for your emotions and a client's, right? So you have to ask yourself as the investor, would I have been able to execute that strategy in 2008 when our long-term trend following strategy and told us to reduce exposure in January of 2008, right? You just ask yourself those questions. Would I have been able to reduce exposure in February of 2020 after the market had already fallen 10%, and then we're getting an indication to reduce exposure by half, right? Those are, if you don't walk through the data and try to make it a part of your DNA, you will make bad decisions, and you could fall prey to the same we all have emotional biases. It's the same emotional bias. It just shows up differently. So what are you doing as the investor to limit or eliminate emotions from the decision-making process? Now, on the client and the advisor side, the advisor, it's the same. It's two sides of the same coin. For the client, what we're trying to do is, because we're looking at trends, and we're doing that over multiple time frames. So we'll look at the trend over the intermediate term, over the long term. So we're trying to create this.
And just not to cut you off, but how do you define intermediate versus long term? What are your goalposts?
So we use price as our chief input, right? That's our primary. Yep. But price in and of itself is fairly noisy on a day-to-day basis.
Yep. Especially now.
Yep, especially now. Yes, exactly. So we're trying to turn this data point into information. And so we want to smooth it out by taking an average over a certain number of days. And so we create this average that updates daily. It's called a moving average. There are various types of moving averages. We use something called an exponential moving average. I'm not saying that because it's fancy. I'm just saying that because what it does is, a standard average equally weights all data points in the series. An exponential average weights the nearer term data a little more than it does the longer term data. So it's more reactive in the near term. That's just a choice that we made. It's not right or wrong. It was just our choice. So in the intermediate term, we look at the average over the past 10 days and the past 100 days, and we look at the difference. So if the shorter term of those is above the longer term, so if the 10 is above the 100, we consider that a rising trend. If the inverse is true, we consider that a falling trend. Now, one thing we do that's differently than a lot of other managers, again, because we are trying to design these strategies with the advisor and the client in mind, is we capture this data daily, but we only react to it monthly. So what we're trying to do is limit turnover, build persistence into the model, because one of the inherent, I'm going to call it a feature, of facet, maybe is a better word, of trend following, is that you get a trend that begins to show itself, you buy it, and then it reverses, right? A whipsaw. And so we're not explicitly trying to eliminate whipsaws. I don't think that's possible, but what we're trying to do is just build persistence into the model so that we have the most data available to us after something happens to make a decision. The longer term trend is defined by the 50-day and the 200-day moving averages, and the same relationship exists there.
So you're long only?
Yeah, absolutely. Yes.
Yeah.
Yes. So what we're trying to do is use the trend following as an asset allocation engine and not as a timing mechanism. It's our belief that markets, there are some people in the world that can repeatably time markets well. But that's like saying there are people in this world that can hit 350 consistently. That's not something I'm going to go try, and especially talk you into believing that I can do it, right? So we don't use trend following for the timing element. We just use it to give us information. And when we deem that our research has shown that when a trend is rising, that represents a market that is more likely to continue in that direction than not, with low volatility. And when a market is falling, markets fall about two and a half times faster than they rise. And it's those environments where volatility expands and catastrophic loss can occur.
So that's where you enter into the short treasuries and the cash positions?
We can, yes. So we devise the portfolios really over, all of our portfolios are designed on the same chassis. And as I mentioned before, we use, where we can, which is almost everywhere, we use passive index ETFs. We do that because they're inexpensive. Up until 4 or 5 months ago, they were typically free to trade. Now all of them are free to trade, more or less. But also because we're the ones doing the active portion. And so we like buying indexes because there's no tracking error. What we know that we can trust what we're buying will deliver to us exactly what we're buying it for. And then it's our job to determine how much of that thing we want exposure to.
And have you gotten to a point where you look at the state of the market, or there's unexpected upside or unexpected downside, and fear that maybe the model's not going to work this time?
Well, I'd be lying if I said that thought doesn't cross my mind.
Yeah.
No, sure. Yeah. And so when that happens, what we do is we go to the data, and we look in the data, and we look at past periods of crisis.
Yep.
We've got data going back to 1790.
And which asset classes? So I saw that on your website, which I thought was interesting. Obviously silver and gold we can track for a long period of time, but stocks less so, right? So it's more difficult of an exercise.
Yes, that's true. Yeah. So we have monthly data going back in fixed income. Yeah. Going back to 1790, roughly that in the UK as well. And then that's US, UK, and Japan. And then the stock data we have actually from about 1850 in the US, and it sort of cascades from there. The UK is a little bit newer, and then Japan's a little bit newer. And because it's monthly, and our current strategies are built on daily data. Really what we're trying to do is look at how does the philosophy play out of cutting losses and riding winners. And then we can take those results and then test them using monthly data or daily data or weekly data or what have you in real time to compare. Because look, the speed has changed, context has changed.
Yeah.
Regimes have changed. The only thing that hasn't is human nature. And so what we, in some sense, now I'm going to get really philosophical, is that we feel like when you have a model that's based on price, what you're really doing is modeling human behavior.
Yeah.
And we feel like regardless of how many machines are operating in the market, they dominate now, the machines are still have to be turned on by humans and are being turned off by humans and are being programmed by humans. And so they're only as good as the emotional constitution of the programmer. And so for us, our strategies will absolutely evolve over time. Maybe the last thing I'll say there is you have to be very careful when you're designing systems to overfit to the past. And so there is a tendency to try to find the optimal solution in terms of parameters. And that's just really, really dangerous. So we try to optimize for emotion and the ride, not the parameters.
So are you able to apply some sort of behavioral benchmark as opposed to just the traditional benchmarks that we would use to monitor performance?
We've been working on that for a while. We're getting closer. I'm kind of mad that you asked that question after, a little over an hour, and it's taken us like 10 years to ask the same question. But look, it's a combination of things, right? And you can use a sort of a weighted factor type model to look at, okay, so here's one way we've done it. Looking at a strategy, let's take, you have to have an anchor point, first of all.
Right.
In our estimation, while the world's benchmark is the S&P, the world's portfolio looks like a 60-40. So in that instance, when we're looking at behavior and a behavioral benchmark, we're looking at something relative to the performance of a 60-40. And it's not just the absolute return relative to a 60-40. In most cases, if markets are rising at 75% of the time, then over a long enough period of time, the best way to beat a 60-40 is to be a 61-39.
39, yeah.
Right? I mean, that's not complicated. So it's not just the absolute return, and it's not just the risk-adjusted return by way of, Sortino ratio or Sharpe ratio or information ratio. It would be how much does this comp that you're analyzing compared to the 60-40, how much does it deviate from a rolling 12-month rate of return from a 60-40? Because if it deviates significantly from a 60-40, that's behaviorally difficult for the investor. And so you've got that. Then it's what is the max drawdown or the max expected drawdown, which is typically worse than the historical drawdown. What do you expect peak to trough to sustain in this comp? And if the answers are it outperforms on an absolute basis and a risk-adjusted basis, but it deviates from a 60-40 significantly over rolling 12s, and its max drawdown is 55%, that makes it quantitatively favorable but behaviorally unfavorable.
Right.
And that sort of gets back to this idea around, what's more important? Is it more important to have the perfectly optimized or a risk managed investment, or is it better to have perfect emotions? Right? What's more important?
So what do you think?
Well,
to investor success or successful completion of goals, so financial goals, which of those two do you think is the most important?
I think in the end, it's emotions.
I would agree with you. Yep.
And the reason is because, okay, let's say you've got if you have the perfect risk managed solution with poor emotions, you will never realize the benefits of the risk managed solution, right? But in order to achieve perfect emotional balance, let's say, or whatever qualifier there, perfect emotions in an investment capacity, it presupposes that you have a risk management solution that will help deliver that, right? So I think if you're solving for the emotional piece, you'll get to the risk management, but you can't flip that arrow.
No, because it requires that you stick to the plan, right? We go back to the diet. The diet's great and the fitness regime is great right up until the bag of chips and beer starts calling me at 11 o'clock at night.
Yes. Exactly.
If I can't stick to it, then it's not going to have the same results.
That's right. And the loss of compounding, as you guys know, I mean, it's immense, especially the longer you take it out, that the opportunity cost gets bigger, compounds at a faster, bigger rate. So, yeah, I think emotions in that case have the edge.
All right, and then the last thing I want to ask, because I know we have other things we want to move on to. There's a million other things I could ask you, but talk to me a little bit about behavioral discipline in ESG investing. Oh
man, yeah. That is such an untapped topic. It's huge.
Also, sorry to cut in, but Brennan, could you also just define that for some of our listeners who might not?
So environmental, socially responsible governance types investing. So investing, pristine investing, let's say, with social conscience.
So I think ESG investing, and we've recently rolled out we just got to the 1 year mark on an ESG equities strategy that employs those same tactics. So I think ESG investing in and of itself is more emotionally friendly than non-ESG because of the passion or the the preference of the investor. It's more than an investment for them, right? It's a cause. It's just a deeper level than picking an index fund.
So doesn't that obscure your objectivity from just straight up from an investment standpoint?
I think it can. I think in the end, everybody's got their uncle point, so it doesn't matter how much they love it. They're gonna fire it if it sucks bad enough or is too painful. That's probably the better way to articulate it. It's just too painful. They're gonna bail.
So it's funny you say that because I have a client who I had invested in energy, and he eventually called me. He was able to hold it for a year, but he said, "Listen, it hurts my soul to know that I own this. So I'm going. I know it's done well, but I can't do it anymore." And so he sold it. And so that I get that point.
Well, my point of view with ESGs is eventually I feel it's going to just turn into a self-fulfilling prophecy because it's a point that's becoming more and more important with millennials. And as these millennials are aging and, taking a larger footprint of the overall market, if everyone is following these trends, that in itself should start to drive the prices up as well. If it just from the demand side of things.
Yes. Yeah. Yeah, it is absolutely a wave that's happening. I don't know if we have a large enough sample size on the factors themselves.
Yep.
I love this idea that the behavior can also obscure the analysis. I haven't thought about that. I love that. So for us, as we look at it, we say, okay, can we combine these two elements, which is allowing investors to have an investment that they're passionate about while also giving them a higher probability of not sustaining a large drawdown. That's really what we're after with our ESG strategy. It's it's not for everybody. I think, Jerry, to your point, pretty soon it's going to be for a lot of people. And so as that preference changes, we just want to offer it in a way that somebody doesn't have to make the choice of, I could buy ESG and lose 50% of my money at any one time, or I could buy non-ESG and lose 50.8% of my money. We want to give them another alternative, right? And then there again, you start incorporating different multiple layers of behavior into that.
Okay.
I think it's really interesting. I think that behavioral and ESG, how what does that bring up if you're forming a policy and a strategy around things that reflect you. I mean, hypothetically, right? These are things I believe in. This is who I am.
Yeah.
And when that's not performing,
Right.
I mean, I just wonder what you would see just overall behaviorally. I mean, this is what I believe. I'm convinced I'm going to seek out that specialist out there who runs that RIA that does sustainable investing. And now what?
And it could just be that you feel better about the 50% loss than you would have if it was non-ESG, right? But again, we go back to it's like this circular argument about whether it's behaviorally driven or not, and whether you can avoid the behavioral biases that come along with it.
I lost 50% of my portfolio, but I kept 50% of my soul. So
Yeah.
Right.
Yep.
Yeah. And then look,
There is no soul in investing.
Yeah. Brendan Zero was Gordon Gekko. Oh boy. Awesome. Yeah, I think that's a good kind of cap. There definitely lots to talk about with behavioral finance. Definitely a topic we'll be coming back to in future episodes as well. But I do want to give Adam some time. Poor Adam. We saved him for the end.
Save the best for last, right?
Exactly. But Adam, he wanted to talk to John about, just being a fiduciary, because we talk a lot about being fiduciaries as CFPs and being a fiduciary to individual clients. I gotta imagine being a fiduciary on the fund level is a different beast.
Yeah. I'm John. This is you. I just want to call out something before John takes this question. So, right on your website, I had flashbacks to the code and standards, the CFP codes and standards. Looking at a little blurb from your website, but that we place our clients' interest and brand above our own. That is so inherently fiduciary of you. So how does that work on your end as an asset manager? Because we know fiduciary on our side of the house, you're providing advice, it's customized, it's personalized to that client. If you hold the CFP marks, you have to be acting in their best interest at all times. How does that work for you?
The nature of the strategies we feel like operate in a very high fiduciary way because, if nothing else, because we seek to use low cost instruments and we seek to be completely transparent. I mean, we are completely transparent. What's reflected there on our website speaks to another aspect of what we do, which is how we serve advisors per se, very specifically. And that is, the advisor is the hero in our equation, right? So in an advisor's equation, their client is the hero. But for us, it's the advisor's the hero. So we are willing to, completely put our egos aside, and in some cases, operate our strategies in the name of the advisor, right? So the advisor can take their brand and put it right on top of our strategies, and we're essentially operating as their investment infrastructure. So, for us to do that is promoting their brand completely and supporting them in growing their business and taking our brand and putting it aside, because then it becomes, and look, being a fiduciary to me means also translates to be symbiotic, right? What wins for them, if they win, we win, right? And in that case, the Blueprint brand doesn't have to be promoted to anyone. As long as the advisor is successful, we're successful.
And that's another blurb on your website as well, helping those investment advisors help the clients who trust them. Another very fiduciary sounding blurb that I saw as well. What are some challenges that come up though on that front? So as you're seeking to act in accordance with the plan, with the strategy, are there moments where that's difficult, where it could be suitable, where it doesn't have to be the very best, where it's good enough?
Investments get analyzed in a multitude of ways, some of which I agree with and some of which I don't, right? So our strategies, when I talk about our strategies, I always refer to them as being robust, which means that they, in my mind, they fit more like a mitten than a glove. So they're not designed for every scenario. Really, no strategy is, but certainly ours is not. And so I guess in that sense, it's no different than the conversation that an advisor has with the client. The conversation we have with the advisor is, what time frame are you focused on, right? Because we always talk about full market cycles. We talk about the long term. If you're compounding from a perpetually higher base, or if you're able to do that, your longer term results are going to reflect it, right? And so you couple that with nobody knows what the future is going to hold. Some people think they do. I mean, some people try to sell people that, they are accurate predictors of what is to come. We take the stance of, we know that we don't know. And so when you get situations like, take for example, this year is a great example of those periods where something happens that's fully expected and delivered by the strategy that is maybe not enjoyed as much by the user, right? It's inevitable. Every strategy has this, but here's ours specifically. So in February, hit a high on the 19th. The market drops about 10% over the balance of the month, and then we start scaling our risk back, right? In our most tactical strategies, that means that we reduced our exposure by 50% in equities. Well, you go through March and that feels great because you've been able to preserve capital in a pretty meaningful way. But then you get a V bottom that happens in April, which is going to happen. Let me say it like this. I can't say going to and then disparage predictors in the same paragraph. So let me say, has happened 100% of the time. After markets fall, they have a reciprocating effect where they bounce really hard. It's only after that you really start to get some information. So the mind of the investor, the memory of the investor is fairly short. And while we know prospect theory, for example, says that the pain of losing is 2 times greater than the joy of winning, right? Well, that also applies to opportunity cost.
Yep.
So you could be better off having missed downvol in March and not experienced upvol in April, but it feels like you should have experienced April and you should have experienced March, but only in hindsight. So that's when our process comes into play in terms of focusing on meeting advisors where they are, educating the advisor, helping the advisor educate their client. I mean, we'll do events where the advisor will invite their clients to submit questions, and we'll answer them over video, or we'll answer them on a Zoom call, or have the clients come on and ask us questions directly, which, depending on the geographical region of that advisor, can be a very brave thing for us to do.
Yeah, because you inevitably get the question, why didn't we sell on February 19th and buy on March 23rd, right?
Right. Yeah. You get those questions, and then, God bless them, you get the questions like, hey, I got an RMD coming up here, and what are we going to? Well, that's not really the purpose of this call, but that is important.
Not this year, sir.
Yeah. So, that's Adam. To your question, that's where the rubber meets the road for us. That's when reality sets in, and you hope that the investor has a positive experience before they have an experience that challenges them. And you remind them that every investment strategy is a compilation of choices, and every investor has multiple choices to choose from. And there's a cost and a benefit to every single one of them. And so really, there's a lot said, particularly over the past 5 years, as the world has migrated to automated advice and robo. One of the biggest value adds an advisor and a planner brings to the table is not only just the goals piece, but in helping the investor wade through 52,000 options.
I think I know the answer to this one, but do you think robos could act in some capacity as a fiduciary?
I do. I mean, some of the features that are present now, look, we're fully systematic. Strategies in and of themselves are very robo-like, right? We just don't believe that we believe in passive. We believe in modern portfolio theory. We just don't think it goes far enough. It's really as simple as that for us. So the idea that the robo can act as a fiduciary, first of all, somebody's got to stand up the robo. right? So ultimately, it's that group that's the fiduciary. But yeah, using low cost funds, no commissions, getting much more precise on risk tolerance, right? And being able to deliver a more customized solution, using technology to deliver in a broader way a more customized solution per client. I mean, that stuff meets a pretty high fiduciary standard in my book, but I don't know what it's going to look like for them to be, to take the next step in terms of that. I'm not saying it can't happen. I just can't see how you get there.
Sure. Yeah. I remember when the robos started to be unleashed, how everyone said, "Oh, here it comes. It's over. This is done." And the more time has passed, the more you're starting to see people do have that personal need. People want to be able to pick up the phone when things happen like they did in the past few months and have someone that's going to pick up and talk to them. If anything, just
people like to be able to blame someone else other than themselves, right? if you got an advisor, you can those bad ideas were all yours.
Exactly.
Yeah. There's no question about that. But Adam, to your point, we saw in a study that was done by a large custodian based in San Francisco that showed that fee compression. We've seen fee compression happen incrementally over the past 6 or 7 years until last year. And last year, on average, in their wealth study, we saw an uptick in average fee. So, I'm not calling the top here in robos, but what I will say is that I think people are, particularly in light of when downside volatility hits, not everyone, but most become reminded of the value of being able to call the advisor and someone with experience or someone who's just been mentored by someone with experience and have a conversation. And it's huge. But when you go from 2009 to January of 2020 with historically low volatility and only 20% peak to trough drawdowns, it's very easy to think that you don't need that. But the market has a way of humbling us, and it did.
Yep. One last question for you, Jon. Do you envision, as Blueprint grows, that the possibility that being a fiduciary or acting in that capacity with your clients, with the advisors, does that become more of a challenge as you get bigger? Because I know your website, it feels personal. It feels like that piece is there. It's transparent. I know that the way you do business and your methodology, is going to be true. But when you have a bigger volume of advisors that you're working with, especially with these more customized strategies, does being a fiduciary become more of a challenge?
That's a good question. I mean, there's no question that one of our challenges is keeping personal touch and keeping, having this culture of building deep relationships at scale. That's hard to do. I don't think we'll be confronted with, do we do that or don't we? Because there's a lot of models to look at. A lot of business models, particularly in tech, have been able to do that successfully. Some have failed miserably. But there's enough, I think, models out there for us to study in order to do that successfully. Now, it may mean the decision of, do you build a business that's more focused on revenue, or do you build a business that's more focused on profitability? That's a question you have to ask when you talk about scaling, particularly a high touch scale. I don't have an answer for you right now on that specific question. But what I'll say to the second one is, or just number two is, what we're seeing is this consolidation of platforms, and these platforms are gaining ground because of the movement towards a higher fiduciary standard, or let's say a broader application of the existing fiduciary standard. And so they're building these platforms, and InvestNet is one of them, where we might, as a money manager over time, get a lower fee. However, they've created the ability for us to scale at least the investment manufacturing and delivery process, right? So it's almost like if you have a menu of your various business functions, operations, investment management, research, compliance, each of them has, its own, each of them could have its own P&L, so to speak, right? And so when we think about scaling our deliverable without sacrificing our personal touch and our relationships, you almost have to shift those around, but keep the answer constant, right? So the variables will change, but you have to keep the answer constant. And so it's definitely, we're not, I don't think, close to that yet, but I hope that we're working tirelessly to be confronted with that Sure. decision. I can tell you that.
Yeah. Good problem to have.
Yeah. I mean, I found it very interesting that when looking at your website, the person with the longest bio on the entire website is your compliance person. Seriously, I mean, I thought that was pretty compelling. The other thing is you got a guy by the name of Rick Bone, which sounds like he should be a detective for homicide in a Quentin Tarantino movie.
Yeah, you know what the funny thing about that is Rick is so Rick started a little over a year ago. He has been a total gift to our business. I mean, he is a fantastic guy, high integrity, really smart, but I have never met, we have walked into so many meetings that he's set up, and you walk in and it's like you walk in with the Godfather. I mean, everybody knows him and everybody's like, wow, remember when we did this and, when we had this and so Rick, I'll say this, Rick really embodies, just because you mentioned him and I can brag on him a little bit, he really embodies the characteristics that I talked about at the beginning of who a blueprint person is and looks, and is how they're made up, right? And smart, great work ethic, but kind and selfless, and he's a great teammate. So and he's a big guy and he has a shaved head and he's a little intimidating too. So well, with
a name like Rick Bone, you should be.
He's got that working for him as well.
Yeah.
Awesome. Well, yeah, I think that's kind of a good place to wrap it up. We went a little long this episode, but I think that's good. Lots of great stuff to talk about. Jon, it's been a pleasure having you on.
Yeah, Jon, thank you so much. Jon. It's good to meet you.
Yeah, you bet. Thank you, guys.
Before we head out, Jon, where can people find out more about Blueprint and about kind of the journey?
Yeah, so you can, Blueprint Investment Partners is blueprintip.com. Blueprintmutualfunds.com is where you can find information about our fund. And then, LinkedIn, you can get a lot of content from our Blueprint IP. That's the website we've been talking about the most here with the fiduciary language and, the transparent box and cube that happens when you go on the website. So, you can learn everything about us at blueprintip.com.
Awesome. Thanks so much. And for everyone listening, if you want to check out more episodes of the BIF Bites podcast, you can do it at bifbites.com. We got lots of great articles and videos and our back catalog of episodes, so check it out. And until next time, I hope you guys all have a great time and stay safe out there.